Afternoon and welcome back to the global UAE Energy Forum, where we're literally circling the globe to our 50 energy analysts and experts around the world for their insights on the outlook for the year ahead for the energy sector, and none more challenging than the whole issue of CAPEX. How will oil and gas upstream investment return to pre-COVID levels at this time of great energy insecurity? And there's no better person to speak on this topic than Joe McMonagle, Secretary General of the International Energy Forum, the world's largest international organization of energy ministers. Welcome, Joe.
Great to be here.
And thank you for suffering through. I know you're recovering from flu, and we really appreciate that you've stepped forward to stick with this commitment. So thank you for that.
I'm happy to do it. I feel good. My voice is not 100% yet, but I'll be there soon.
But you've got that husky Texan sound, or whatever the
That's right.
equivalent is. It,
It's my new look.
your new look for 23. Well, stick with it. Your old look at the IEF for 2022 and early in fourth quarter, and it's a message you have repeated through the year that global crude oil inventories were well below 5-year averages. For at that point in the fourth quarter, 400 million barrels below 5-year averages. We saw global demand was at 99% of pre-COVID levels, but yet crude oil production, as you were reporting at the IEF, was still 96% of pre-pandemic levels. So a lot of imbalance in that supply-demand structure. I'm wondering, what's your outlook for the year ahead? The return to something a bit more healthy in that supply demand balance in 2023.
Well, thanks, Sean. And as you're circling the world in this event this week, I've spent most of 2022 circling the world myself, and so I've had a chance to meet with ministers in different parts of the world and get some perspectives. And I would say our outlook for 2023, I think really there's still a very large element of uncertainty. And I say that because, especially on the demand side, there's this threat of the recession and what that may do to demand. And then, of course, you have the China reopening and what that may or may not mean for demand, especially on the upside. On the supply side, we continue to have constraints on investment in new supplies. And then, of course, there's the whole question of Russian production and what recent sanctions and price caps and what Russia may decide to do themselves means for Russian production. And I think the jury is still out on all of that. But
One
I
of
think
the,
go
sorry, go
ahead.
ahead.
No, I would say without adequate inventories, spare capacity, and investment, really volatility, I think, is likely here to stay.
It certainly was a big deal last year. Nearly every day was seemed like a $5 swing in both directions. In particular, Joe, I'd welcome your thoughts on the US. I think of probably the many surprises of 2022, where at the end of the day, Brent crude oil did average at $100 a barrel, and yet US oil production never made it back to pre-COVID levels, still down about 1 million barrels from 2019 levels. I'm wondering what your perspective on that, on the outlook for that extra 1 million barrels to come back, or is that gone forever? Why is America, why are US oil producers not putting money in the ground, so to speak?
Well, look, I think there's several factors at play, and most of them are on the investment side. There was a lot of encouraging by governments to suppliers to increase production, but we need to, I think, bring the investor community into that conversation. But in terms of your question on the U.S. in particular, I think number one, there's still a lot of uncertainty due to the recession and what that may mean. A lot of these companies have seen, the boom and bust cycles. And so they're trying to be, I think, conservative. There's this whole new era of capital discipline. Investors are demanding better returns from the sector, and so the companies, the public companies, are trying to be responsive there. And of course, you have ESG and on all those sustainability constraints on investment as well. Um, Willingness to invest is a key constraint as long as profits are high. But if profits fall due to lower prices or things like new windfall taxes, then capital availability becomes the key constraint. So I would
Well,
say
there
it's
seems to be lots of capital around. It's, in some ways, it feels like, particularly the U.S. majors, are feeling the pressure of the transition in order to retain investors and retain their shareholder base. They've got to pay them these massive dividends. It seems that, I don't know where is that payback from the bad years, but it does seem like that desperation to keep those shareholders, those pension funds happy so they stay involved.
Well, yeah, I mean, they're responding to their investors. But I'd have to say that I still think there's a negative investor sentiment and other hurdles in the sector. But having said that, oil and gas upstream capital expenditures globally have increased by about 39% in 2022 to $141 billion. And that's the highest level since 2014, and that's 13% above pre-COVID levels. But really, I think we have to be cautionary about that because the increased spending really reflects rising costs and inflation, not just increased activity.
Am I wrong? But I think I've seen the IEF report that we need to see oil and gas upstream investment upwards of $500 billion a year through 2030 to ensure market balance.
Well, actually, Sean, we're getting ready to update that report. That report is from a year ago, probably the end of this month or early next month. We will come out with the new report with our partner S&P Global. So I'll preview some tidbits from the
Please, yeah.
report since we're in the middle of it. Um, Really, we think now that upstream investment will need to increase from about $500 billion in 2022 to 640 billion in 2030. And again, I think the higher estimate than a year ago is due to these rising costs and inflation. But cumulatively, $4.9 trillion will be needed between 2023 and 2030 to meet the market needs and to avoid a shortfall. And it's not needed not just for new supply, but offsetting production declines, which I know that you are and your viewers are fully aware of. Without additional drilling, we estimate that non-OPEC production would decline by 9 million barrels per day in 2026 and 17 million barrels per day by 2030. That's a 31% decline.
That's beyond the COVID collapse, if you like. And it does seem that some of those countries, those OPEC plus countries, are struggling to bring their production capacity back.
Look, I think the bottom line here is, and you asked me for my outlook at the
Yeah.
beginning, if we fall short and investment in hydrocarbons continues to be constrained, I'm really concerned that high prices and volatility will be the new normal.
And that's what's at stake really here, isn't it? At the end of the day, for everybody, as that energy security premium, if you like, also comes into play. Uh, Looking
Well,
at the yep.
I was just going to say, underinvestment definitely threatens energy security in the short and medium term. But in our view, it can also undermine progress on climate change and the transition. And that's because if the public starts to equate high prices and volatility with transition policies or climate action, we'll lose public support. And so I'm very worried, and we have to be very careful that we manage this transition and really focus on this underinvestment issue.
looking again at the situation in the US, where there is the transformation of the shale oil boom of a decade ago, which was made up of thousands of mom and pop kind of producer sizes, but has consolidated over the decade now to being in the hands primarily of the big actors. I'm wondering what your thoughts are, what your outlook is for them. Now that the shale oil opportunity in the US is consolidated in these big companies, do you think big oil is preparing to spend a lot more in 2023?
Well, as I mentioned, based on 2022 evidence, they are spending more money, but really it's a result of inflation and higher costs, and
I mean, it doesn't seem to be reflected in production levels. I mean, ultimately, they
right.
might be
Well,
spending.
right, of course, but they are spending more. But they, as we discussed, they're also, I think, being responsive and under pressure from the investor community, and that's why, as I said, I think we can't just be talking to the companies and urging them to increase production. We need to be talking to the investor community and urging them to be more open to higher expenditures for upstream oil and gas, for energy security, for things like continued progress on climate and the transition. And right now, the system is not set up for that discussion. We need to broaden, I think, the parameters of that discussion.
I mean, bringing Wall Street on board with lowering ExxonMobil's profits. I mean, it is a strange scenario where, I mean, in previous cycles, when we've seen this scale of revenue, you would see more dollars going into the ground. And I mean, the size of the dividends is beyond. I mean, it's massive. It seems that it's somewhat incongruous that the intention of the oil majors to be the sort of provider of the new marginal barrel, like we saw in the shale revolution 10 years ago, sets up for really dependence, greater and greater dependence on NOCs. Your thoughts on the role going forward for the national oil companies to be that extra supply in a way where we saw for many years and decades OPEC's share of total production decline. Now we might be looking at something different.
Well, look, I mean, they have the same pressures on the investment side as well. I mean, if you look at OPEC production, a lot of the last cut of 2 million barrels a day in reality was really just 1 million barrels, because most of the members of that OPEC plus group are not even producing at the target that they're supposed to be producing at, because for the same reasons why investment is down in the U.S. And these countries just did not invest, mainly because of I think a large in terms of the NOCs, a large part of it was because of uncertainty regarding COVID. But they're facing the same issues in terms of investment, and there's only so much the others can do here. And the gap between supply and demand. I think everybody assumes that's just something that OPEC or OPEC plus can fill the gap, but really half of the gap is coming from my country, the U.S., which is the topic we've been discussing.
Now the world's largest LNG exporter, which brings us to the legacy. Now we're coming up to the first anniversary of the Russia's invasion of the Ukraine, and the disruption that has caused, massive disruption to energy flows although oil continues to flow, but ultimately the direction and the markets where it's going. What do you think is the legacy 1 year on from this disruption to the global energy markets and global energy flows? And what do you think going forward beds in as kind of permanent?
Well, look, I mean, we haven't really seen a big impact, I think, yet on Russian energy supplies.
Well,
Uh,
80% of gas that went to Europe doesn't go there anymore. That's
right,
pretty
but
big.
yeah, it's being redirected. But I guess there are obviously specific concerns regarding Russia that will have to be addressed. And the EU, I think, is taking steps here. But what I would say regarding high prices, both of LNG and natural gas and oil, I think it would be a mistake for the lesson to be learned to blame all of this on the war in Ukraine and Russia. This was already happening before the war in Ukraine. And we have to recognize that the root cause of this is really this underinvestment in hydrocarbons. And until we grapple with that and focus on that, as I said, unless we address, if investment continues to fall short, really high prices and volatility will be the new normal, regardless of whether there's a war in Ukraine.
Well, sanctions alone, I mean, when you look at now Russia, the world's largest provider of commodities, the largest provider of energy, oil and gas combined, now under heavy sanctions, Iran, another big oil and gas producer under heavy sanctions, Venezuela. I mean, there's a lot of sanctions, a lot of politicization of oil and gas all over the world. The cumulative effect of that seems to be part of this big problem.
Exactly. And if you look at the rationale behind the G7 price cap, it's to try to mitigate the impact of sanctions. Now, whether it will be successful or not, I think is another. I mean, the jury is still out, I think. But even the countries that are imposing the sanctions are trying to mitigate the impact of sanctions because we are a global market. You can't just turn off energy in one part of the world and expect it not to impact the global market. And so I think, as you said in one of your earlier questions, look, energy security is now back, and countries are now focused on this in a way that they haven't been before. And I think it's realigning policies, and it will be realigning, I think, strategies moving forward on many fronts.
And probably alliances where countries will choose whether or not to comply with sanctions when energy security will be the priority. I just want to finish on that point and finish going to China, which of course would be the biggest actor on that level. Nobody's going to tell China what to do or not do in terms of complying with sanctions. But how do you think China's reopening will impact energy markets in 2023?
Well, I think this is the big question. And I mean, I think the reopening already has I think I think it's being underappreciated in the market right now. I think people are really just pricing in a global recession without focusing on what China's reopening could mean for demand. I think it has tremendous potential to have a lot of pressure on demand and further tightening markets. And so I think the focus right now is on the recession and what that would mean for demand. Although I would caution that any kind of downturn in demand from a recession is really temporary, and normally demand comes back faster and in greater intensity than people expect. But if you throw China into the mix, I think that's really not yet being priced in to the financial markets. And as I said, I think in one of our previous conversations, Sean, we're really in a tale of two markets here. the financial market is really just focused solely on recession and bad economic news and what that means for demand. But the physical market is still quite strong and tight, and adding China's return, both domestic demand now that people domestically can travel, but also international travel and a reopening to international travelers. That's going to have a huge, I think, impact on demand in 2023, and we just have to see how much. But I think the pressure on demand is going to be great in 2023, and we're going to be focusing on supply gaps in 2023.
And I think very quickly that could be seen most acutely in the European gas markets, which have eased off from their crisis tension point in the last few weeks. But it wouldn't take much for China to gobble up a few spot LNG cargoes and that all tighten up again. We have to leave it there, Joe. We could go on, and we will, I hope, again in as we go into the year. And an OPEC Plus meeting, you would think their next one would have to think a little bit again about whether they bring back some of that million barrels they cut at the end of last year. A lot of questions to answer. And as you said in your main points there, a lot of reasons why volatility is likely to hang around in 2023, unfortunately, as we saw in 2022. But thank you very much. It's been a pleasure to have Joe McMoneagle, Secretary General of the International Energy Forum, joining us today at the Global UAE Energy Forum. Thank you.
Thanks, Sean.